Private credit is a big industry. If you can't get funding from a traditional lender, you would go to a private credit fund. Let's say you're buying an airplane hangar. It's not a normal piece of real estate. You would probably go to somebody that's going to lend on collateral that's outside the scope of residential real estate. Maybe you need a commercial property loan, but it's, there's something unique about the property. You're probably going to go to a private credit fund. You need, a business loan. It's not an SBA loan and you can't get traditional lending. You might go to a private credit fund for that. So things that are outside the wheelhouse of traditional lenders, that's where you're going to go to a private credit fund, and they tend to charge pretty significant interest rates for that, somewhere between 11 and 20% a lot of the time. And that's how they're able to generate outsized returns for their investors. Now, the downside on that is if they didn't underwrite the risk correctly and the collateral is also being devalued and people start missing payments, now the recourse on that becomes less than what they loaned on it potentially. Maybe they're doing 50% LTV or 60% LTV. If you see a collapse in prices and people are starting to default, that's where things can go sideways very quickly. So it is risky, while the markets are good and they're lowering interest rates and things like that are working, and there's access to liquidity and there's no issues. But when you start to see the economy contracting and people start to not be able to make payments, that's when private credit funds start to lose money. And that's why people are starting to pull out of them now, because they see that on the horizon.